A very good evening and a warm welcome to Personal Finance. I am Gugulethu Cele. Now today, joining us via Skype from Umhlanga in Durban is Hedley Lamarque, Certified Financial Planner at BDO Wealth Advisers, to help us take a closer look at the recent changes regarding capital gains tax that were announced in the budget speech for 2016 and how best to maneuver around these changes as we enter into the new tax year. Thank you so much for joining us today, Hedley. Perhaps for ensuring that all the viewers and ourselves are on the same page, let's take two steps back and start off with the foundation and the basics with regard to capital gains tax. What exactly is CGT and how does it apply to our assets?
Hi, Gugu. I think that maybe the easiest way to explain it, I think the name is almost self-explanatory. It's pretty much a gain on your capital, if you sell something or basically the proceeds you get from that. Maybe I should just give you a bit of an example that'll probably help. So let's say you had shares, let's say you bought shares a couple of years back of say 400,000. You sold them a couple of years later for $1 million, or sold them say last week for R1 million. The difference between what you paid for them, the 400,000, and then the R1 million that your proceeds that you received on the shares, that is a capital gain. So that 600,000 would be your capital gain. How it gets included in taxable income, it's pretty straightforward. What they would do is the receiver gives you what they call an annual exclusion every year. The current year it's 30,000. So if you took the example I gave you now, you'd say you'd have the 600,000 as a capital gain, less the 30,000 the receiver allows you to exclude, gives you a 570 capital gain, and then the receiver of that he includes a third of that currently. I'll chat about the changes just now. So basically on that 570,000, a third of that would go into your taxable income, i.e. 190,000, and then you'd add that to all your other taxable income, i.e. your salaries, interest received, etc., and then pay tax on that. That's probably about the simplest way to explain it. So it's pretty much just any time you dispose of any capital assets that you have, you would pay capital gains.
Having said that, I do understand that there were recent changes with regard to CGT and how it applies from the most recent budget speech we received from the Finance Minister. Walk us through what the major change is and how it applies to consumers.
I think there were two changes. The big one actually was that they increased that inclusion rate. I gave you the example just now where you included a third of your capital gain in your taxable income. They've pushed up that 33.3% to 40%. So obviously you're going to be paying much more capital gains tax going ahead from tomorrow. And then also that exclusion, the annual exclusion I was talking about earlier, the 30,000, they've increased that to 40,000. So you can take off 40,000 before you work out your capital gain.
I understand that you do have some suggestions as to how best to navigate this particular environment, in particular cashing in on the exclusion rates. Is there a way in which we can tactfully do so, especially if it is working over 2 tax years, if that's possible?
Yeah, obviously I think for the current year it may be a bit late because this is the last day of the tax year. But pretty much what you could have done is, let's say you had a gain of, say, a capital gain of, say, 70,000. What you should actually have done is cashed in part of your investment in the current tax year, get your 30,000 exclusion, and then the next tax year cash in the next 40,000. So basically you'd effectively then get your whole 70,000 tax-free. Obviously you can't do that from tomorrow because tomorrow's the new tax year. But if you could wait, what I would suggest you do is then you rather cash it in over the next tax year, so end of next year. So you cash in 40,000 in that tax year, and then almost the next day, the 1st of March, you could effectively cash the next 40,000 in. Thereby not actually paying tax on 80,000 of your capital gain.
Hedley, this certainly does sound like it could be quite a complex calculation for novice investors as well as retail consumers out there. I take it the best place to always seek advice would naturally come from a financial planning professional like yourselves and your colleagues in the industry to provide further clarity.
Yeah, I think on capital gains, you can speak to any financial advisor or even your tax advisor, because obviously they know the tax laws out of the back of their hand. But it's actually, as I say, it sounds complicated, but it's not actually that complicated. It's effectively just taking whatever you whatever your amount is and subtracting what they call the base cost, whatever you paid for it. And that, as I say, the difference of that is the capital gain. And you just multiply that by, in a new year, by 40%, and you put that into your taxable income. So it's not too complicated. There are a few exclusions though. So, for instance, if you do sell your primary residence, which is obviously the place you stay at the moment, your first 2 million rand of capital gains will be tax-free or excluded from your capital gain or from your taxable income. And then obviously anything, if you make anything over 2 million or any profit over 2 million rand on your primary residence, that would then obviously go into your taxable income. And there are a few other exclusions, like obviously most of your personal effects, like your motor vehicles, furniture and fittings, that type of stuff. You wouldn't pay capital gains if you sold any of that.
What about particular exclusions for individuals above the age of 65? Do any apply?
They get the same rate. So from next year, they would get the 40,000 annual exclusion. The difference there is obviously what they do is they get a higher rebate on their taxable income. So they wouldn't have the same rebate. So as you get older, up to say 65, your rebate that the receiver gives you back on your taxable income would be, say, for next year will be 13,500. The year after, if you go above 65, between 65 and 75, your rebate then goes to over 20,000. So effectively, as you get old, you get more of a tax break from the receiver on your actual taxable income. It's not really on the capital gains. The capital gains would still be your 40,000 exclusion.
Hedley, on the topic of exclusion, you alluded to particular asset classes and asset groups just a moment ago, which might not necessarily be impacted by CGT or have particular exclusions there. For consumers who might be watching the show, I take it, again, when it comes to all things tax, they need to ensure that they disclose all relevant information quite accurately so to avoid any significant penalties that might be received from the receiver of revenue.
That's correct. If you look at the tax return, it's got a section there for your capital gains where you would actually list what gains you made for the year. I think the key thing there is rather earn on a bit of caution. So rather speak to your advisor or speak to your tax expert just to confirm that what gain you have made is whether it will be included in your taxable income or not. Because what you don't want to do is not disclose that you sold, for instance, let's say shares, and then the receiver picks it up a couple of years later, because there obviously would then be penalties involved. Just on one thing, let's take an example. Because some people get confused between what is income and what is capital. So let's say a person's got shares and they're buying and selling shares on a daily basis, or what we would call speculating. Those wouldn't be capital gains. Those would fall under normal taxable income. For it to be capital, you've got to keep it for at least about 3 years or over 3 years. And then let the shares or unit trusts grow, and then that gets classified as capital.
Having said that, though, Hedley, would it also be possible to manage the frequency within which you pay CGT tax? Because if it's slightly different to income, as you've alluded to, I take depending on the date of disposal of the particular asset, then that would naturally apply with regard to the level of CGT that the consumer would have to pay.
Yes, what you could end up doing is let's say you and your wife have both got quite a few investments. Instead of letting the thing build up over, say, 10 or 20 years, what you could do is each February cash out some of your investments and then take advantage of your 40,000 exclusion each year. That way, each of you get effectively 80,000 rand capital gains tax, or capital gains that you don't pay any tax on. I mean, if you look at it over 10-year period, that would be 800,000 of capital gains that you wouldn't be taxed on. Whereas if you left those shares or unit trusts to grow, and you cash them out in year 10, you would pay the capital gains then.
Indeed. Thank you so much for the fantastic advice. But before we do wrap up our conversation, let's get a quick recap of some of the key takeaway points we've learned tonight. Hedley, perhaps if you could give us a refresher on some of the key takeaway points that viewers need to bear in mind from tonight's conversation.
I think a key thing there is just to make sure you do pay your tax or disclose all the tax that you have got or your income, especially your capital gains if you have made gains. And also then try and plan when you actually cash out some of your investments. So try to take advantage of the annual exclusion, because I mean, the 40,000 per person each year is a good thing to bank and rather reinvest it in something else. And I think that the key thing there is just main thing is just to manage your money wisely and then look at trying to pay as little tax as possible, but obviously within the legal framework. You could even consider putting some of the money you cashed out into tax-free savings accounts, which you don't pay tax on those. And also, I think people also sometimes forget about the retirement annuities, because you can obviously get good tax breaks on those as well. So rather try and put your money into retirement annuities if you can, based on the allowable limits at the moment. And as I say, you can structure your tax to a point where you actually pay less than you should if you haven't put into these different structures out there. But for the man on the street that's not too sure, you would obviously then need to speak to an advisor or a tax expert just to make sure your affairs are managed properly. You are paying the least amount legally.
Thank you so much for that sound advice and some suggestions there, Hedley. Well, that's where we'll leave it for Personal Finance tonight. A big thank you once more to my guest, Hedley Lamarque, Certified Financial Planner at BDO Wealth Advisers, joining us via Skype from the warm city of Durban. Well, do remember that we want to hear from you, so send through any of your suggestions or comments to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu on Twitter. Until next time, have a wonderful evening.